Welcome, everyone. Thank you for joining our webinar. My name's Aidan Smith. I'm a partner here at HLB Mann Judd, and I'm your host for this morning. So today we're presenting Financial Reporting and Tax Update. It's presented by your panel of experts, Jolyon Dare, Carmen Ridley, and Michelle Warren. So, first of all, I'd like you to introduce you to one of the all-time great HLB people, okay? It's not me, not in this instance. I'm talking about one of our tax consulting partners, and that is Mr. Jolyon Dare. Now, I'll just read what it says here. It says here that Joel is a highly qualified and seasoned taxation practitioner. I would agree with highly qualified. I can't comment on seasoning. Those all top chefs will tell you you need some seasoning to improve your cooking. So if Joel is highly seasoned, that means a much improved tax advisor compared to someone else who hasn't been covered in salt and pepper. Through ongoing presentation to members of the Tax Institute and CAANZ, Joel has become recognised as an industry thought leader due to his understanding of commercial taxation matters. And Joel does apply a very commercial outcome to all his clients. So I'd now like to hand over to Joel, who's going to give you a bit of an update of what's happening in the tax world.
Okay, Aidan, thank you very much for that introduction this morning. I haven't been salted and peppered this early in the day before, so hopefully we'll spice it up a little bit along the way. To talk a little bit today, I might move over to the next slide now, just to talk through where I'm going to take you today before I introduce Michelle and Carmen. A quick refresher on the tax loss carryback. We looked at it this time again last year. It's become a little bit more current this year because there's a lot more going on and a lot more eligibility, and it's something that will probably be at the forefront of a lot of corporates' finance functions at the moment to make sure they don't miss out on potential refunds, and also to make sure that they get those refunds on a timely basis, especially if you're in a situation where businesses are operating currently at a loss. The second thing I'd like to talk to you about today is something pretty new. It's somewhat taxy. It's a great deal more interest on a general compliance and commercial basis, but it is administered by the Commissioner of Taxation. And so that always sort of raises the hairs on the back of my neck a little bit and makes me pay attention. It's the payment time reporting scheme. It's slightly been in submarine mode up until now. It hasn't had a lot of prominence, but it certainly is going to be quite important for those corporates who are affected by it. And in fact, when we look at the operation of the payment time reporting scheme, you'll see it actually extends out into government organisations, not-for-profits, and a range of other entities as well. I might flick over there to the next slide. So just to start off here with what is the corporate loss carryback regime? So prior to the enactment of the corporate loss carryback regime, if you're in a situation as a corporate where you made a profit in year one and a loss in year two, that was a particularly bad outcome because you are still liable for your tax in the first year and you get no relief for the fact that you make a loss in the second year. And a lot of corporates are expected to be in that situation because of changes to their turnover as a result of the pandemic operating environment. As a result of that, we have the corporate loss carryback, which is a temporary measure. It's available to be applied in the 20, 21 and 22 years. It only applies to companies. And what it allows you to do is if you make a loss in any one of those 3 years, you're potentially eligible to take that loss, apply it back against taxable profit made in earlier years, and to claim a refundable tax offset when you lodge your tax return. And there's a little twist that makes it much more interesting or spicy, if Aidan would say it that way, for the 2021 tax lodgement. And so what does it operate for? It basically will operate for any businesses that expect, they're operating through a company and they expect that they may have a tax loss in any of the 2020, 2021 or 2022 income tax years. Now that's quite an attractive measure, especially if you're in a situation where business turnover or operations have declined significantly for a corporate, such that they might be able to access a tax refund for losses incurred in those years. It's important to understand what the limitations of the loss carryback are. So you've got a maximum of $5 billion of turnover for which you can be eligible, and more concessional measures mean that $5 billion of turnover can be measured just on an Australia-wide basis. It's only available for companies. So if you have a loss which is being arisen through the conduct of business through a trust or a partnership or any other kind of entity, that will not be eligible for the loss carryback regime. The amount that you can claim as a refundable tax offset for the loss carryback is limited by the franking balance that you have available at the end of the particular loss year. So for example, if you've made a loss in the 21 year, you have to look at your franking account balance, and that caps effectively the amount that you can receive as a refundable tax offset under the temporary loss carryback measures. But also there's a second limitation here. It's not just the franking balance at the loss year that you have to keep in mind, it's also the amount of tax that you paid in the earlier year. So a simple example there would be if you paid $200,000 of tax in the 2019 year, 2020, you've got 300,000 in franking credits and your loss is 500,000, or you'll be limited to the 200,000 that you actually did pay in the 19 year. But both of those two factors there, the franking balance and the amount of tax that you paid in the earlier year, they act as a cap to the amount that you can claim as a loss carryback tax offset refund. Now, an interesting quirk that arose through the creation of the loss carryback regime was because it occurred effectively after the 2020 reporting season was in place. Even if you did have a situation where you had a loss which was eligible for carryback for the 2020 year, you had no ability to claim it through the 2020 tax return. The first chance that you actually get to claim a loss carryback arises on lodging your 2021 tax return. So that's an important aspect, which means it's probably twice as important this year to make sure that you have considered the loss carryback, because effectively when you lodge your 2021 tax return, you might be in a position to claim for either or both of losses for the 20 year or losses for the 21 year. Another couple of housekeeping aspects here. You must have a good lodgement history. So usually that means 5 years of continuous lodgement, unless there was no obligation to lodge. That is, for example, if you're a startup and you don't have 5 years of operations, then you can be exempted from that requirement. But it is very important to make sure that all of the preceding 5 years worth of tax returns have been lodged, because that can actually block your ability to receive the refundable tax offset. It's important to note that you're not able to apply the loss carryback for capital losses. And as a final note there, if you're going through any kind of changes in corporate structure, or you're going through an acquisition process such that you move into a tax consolidation situation and incur a loss, once you do that, you can't actually look back at the tax payable by the subsidiary before it joined the tax consolidated group. And a takeaway from that would be, if you are going through a corporate restructure such that you consider consolidating, have a think about how these loss rules would apply if you do elect tax consolidation, because it might be that as a result of moving into tax consolidation, you actually eliminate your eligibility for the tax loss carrybacks. So it's just a point to. Now, the thing that really makes it very important right now is, although it was considered to be, I suppose, a bit of a macroeconomic stimulus, it's a curious one, because although you're eligible for it from the 2020 year, you actually couldn't get the cash and therefore the stimulus involved until you lodged your 2021 tax return. So for that reason, it's really important to have a mindfulness that this loss carryback is available, and also that you've actually got the ability to claim 2 years in one. And for businesses that are doing it a little bit harder in the last year and a half or 2 years, that eligibility for a carryback refund probably will be very valuable. You don't have to apply the loss carryback refund. It is in fact an election that you can take. You can actually choose to, instead of, even if you're eligible for the loss carryback refund, you can choose to carry your losses forward and apply them in a later year. That would be a little bit unusual. Perhaps you're trying to hang on to franking credits. I also think it probably gives you potentially a little bit of an interesting financial reporting issue there, so that when you hit year end, you haven't yet made your election to claim the refundable tax offset. So whether or not that should in fact be treated as a current tax asset, or if in fact you leave it to be disclosed in a different way. But I'll leave that one for Carmen and Michelle to give you a view on. So I might move over now to another overlooked aspect here, which is on the next slide. So there are some integrity measures that relate to the loss carryback. So Treasury was a little bit concerned, as you can see from this slide, that they thought that it might be possible for businesses to be rebirthed as a startup within an existing corporate shell, and a corporate shell in which there's a history of paying tax and also franking credits available. What they were concerned about there is that people would, I suppose, if you like, rebirth a corporate shell with a startup business making losses so that they could get themselves into a situation of being entitled to claim the loss carryback tax offset refunds. So I've set across the bottom there some of the factors that are important to keep in mind if you are potentially in a situation where you're eligible for the loss carryback. It probably just relates to a situation in which you've got the sale of a company with tax-paying history, a full changeover of assets, and the startup of a substantially new business within a corporate shell. So it's really important, if that happens, to make sure that you've got some continuity either in the ownership or the conduct or the assets that are being used within the business. So moving on now to payment time reporting. Which is an interesting one, as I said in my prefacing today. It's not quite tax, but it is going to be ATO administered, and therefore there's a whole bunch of tax definitions which apply here to understanding how your reporting works. So just a quick, what is it? What it is basically that there are a series of defined reporting entities conducting enterprises in Australia, and they have reporting obligations, and they are reporting obligations that relate to the way of the payment terms that they permit or enforce in relation to suppliers who are small businesses. So there is I suppose, a political dimension to this one that comes out a little bit when you read through the explanatory materials that came out with the legislation. And what it's really getting at here is to make a lot more prominent or visible where what you might refer to as large businesses, that is ones with over $100 million of turnover, are effectively determining payment terms for their small business suppliers, which are not necessarily favourable. So entities that are reporting entities over $100 million of turnover, which can be on a global basis. So if you're part of a multinational enterprise, you probably are within this reporting regime. Then you would be in a situation where every 6 months you have to report through a portal on the industry website, and I put that down the bottom of the slide there, on what kind of payment terms you're applying in practice to small business entities. So that's quite a substantial reporting obligation, and so each affected or reporting entity has to report within 3 months of period end, and the first reporting period ends on the 30th of June 2021. So that means that if you're one of these over $100 million turnover entities or part of a more than $100 million turnover group, then you probably are in a situation where you have a reporting obligation from the 30th of September 21. And if you want to see just how detailed the level of information is that you have to supply to Department of Industry, have a quick look at that link that I've put on the bottom of the slide there. It covers about 40 different fields, which include such things as the number of days that it typically takes for you to actually pay each one of your small business suppliers, and then also breaks the payment days for a particular period into a range of different bands. Now, what is a small business, and how does a reporting entity identify a small business? Well, that's quite a complicated thing. In most cases, you wouldn't be able to identify it. So a small business is defined as something with a less than $10 million turnover. And in most cases, taxpayers or reporting entities won't have any visibility about whether or not they're actually dealing with a small business. So the way that it works in practice is that you're required to load up each one of your ABNs for each one of the suppliers against a list there, and then they'll indicate to you which one of those entities are excluded from the reporting regime. And why would they be excluded? Because they're identified as being a medium or large business. So I guess what my takeaway from that one is, by default, everyone is a small business, unless when you run them against the database, it's provided they get excluded as a medium or large business. So it's quite a comprehensive reporting regime. It's quite compliance heavy, and you have to do it every 6 months. A little bit more detail on where all this information goes. So it's not actually a tax-paying obligation, but what we are seeing is there's an enforcement and penalty regime which will apply to businesses that don't comply or don't supply sufficiently accurate information. So ultimately, for each reporting entity, the information that they provide into the Department of Industry and gets administered by the ATO will get publicly released. So all taxpayers that are in the public domain will be able to look and see for each reporting entity what kind of payment performance and payment terms are actually being extended to small business entities. So there'll be a compare and contrast, which gives, I suppose, really important feedback for larger entities, but also for small entities dealing with a large customer. They can compare the payment terms that they're receiving from a large customer with the standard that they've already reported to the Department of Industry. So I suppose what we might see from that is if you you'll see a great deal more about what reporting entities' payment behaviours are, but also small business entities will be able to compare how that large customer pays their small business entities typically, and can use that as information if you've got any commercial negotiations. I've touched a little bit on that central aspect there as to how you identify your small business entities. Now, we're not in the penalty phase at the moment for the reporting scenarios, but the penalties that could apply would be up to 60 units for not reporting. A unit, I think, is currently $222. So we're sort of talking tens of thousands of dollars if you don't comply once that penalty regime's in full swing, and nearly 6 times that amount if you have inaccurate reporting. So when it's up and running, it'll be really important to have systems and processes that mean you can supply this on an accurate and timely basis so that you're not exposed to any risk of non-compliance. Interestingly, the provisions also don't exclude application to the Crown. So government entities, you don't have to be a for-profit taxpayer to be subject to the payment time and reporting regime. Charities are specifically excluded. The government entities are not excluded at all, although they are exempt from the penalty provisions for example, not reporting or inaccurate reporting. Also, if there are any questions on either the corporate loss carrybacks or the payment time reporting scheme.
Joel, I've had one question come through. It's just with the payment time reporting regime, that applies to local government as well?
Yes, there's no carve out for local government. So they would have an obligation to report, but would not be subject to the penalty regimes.
Okay, and I've got one question. Obviously, this one doesn't apply to me or any of my clients. It's that old asking for a friend. But with the Loss Carryback, if you said everything's got to be up to date, if someone's late in a particular year or they've waited for a number of years and they do catch up, is that going to impact them, or is it as long as they've lodged those 5 years before they apply, they're okay?
Well, yeah, look, I think you just have to catch it up, basically. Okay. So you have to have disclosed. I think what they're getting at with that particular measure is you can't have avoided a tax liability in an earlier year by not reporting it. So yeah. I think that's the key part, is you have to get all those 5 years up to date if in fact you've got a lodgement obligation.
All right. Well, thank you, Joe. That's all the questions that have come through. So you've obviously your presentation's addressed everything that everyone's any questions that people had. So it's something else. It's good that we got the Loss Carryback, but then another level of compliance that's coming out as well. All right, now I'd like to introduce our next presenters. It's the Dynamic Duo Financial Reporting Updates. It's Carmen Ridley and Michelle Warren. So Carmen's a member of the GAAP Consulting Network and also principal of Australian Financial Reporting Solutions. And Carmen specialises in financial reporting advice, accounting standards interpretations, technical training and financial statement reviews. Carmen's also an excellent knowledge of financial reporting. She's significant experience with major accounting firms, both external audit and technical divisions, and she's helped analyse and interpret accounting standards for a number of clients. Also got Michelle Warren. She is HLB's National Financial Reporting Director. Michelle provides leadership in financial reporting matters across the HLB Mann Judd Australasian network. That includes overseeing the network's thought leadership on financial reporting issues, developing and delivering training content to meet the financial reporting needs of our staff and our firms. So given both Carmen and Michelle's level of expertise, I'll suggest that both of them have also been heavily seasoned, and that's good news for all of us. And if you're joining in this presentation late, wondering what I'm talking about, doesn't matter. Okay, so without further ado, I'm going to hand over to Carmen and Michelle.
Excellent. Thank you, Aidan, and welcome everybody. The way we're going to structure this session is I'm going to talk to you about removal of special purpose financial statements, and then I'm going to hand over to Michelle, who's going to cover the other 3 agenda items. As mentioned, please ask questions throughout. We have got the question and answer panel, and we will try and answer as many as we can at the end of the session. Particularly around the removal of special purpose, it's really important that you know who is affected and what the impact is going to be. So please don't leave not knowing those. We're more than happy to take a question, even if you think it's silly. We're not going to name names. We're not going to shout out. We'd rather just answer the questions. So let's get started. We've talked in previous sessions about the fact that the Australian financial reporting framework is changing, and the way that we traditionally view special purpose, general purpose is changing. We just want to reiterate some of those points because we are at the 20th of May and there are some significant decisions that need to be made. So let's look first of all at who is impacted. And again, we've talked about this previously, but both Michelle and I are still receiving a significant number of questions where entities think that they may be captured, but they're not quite sure. So I put together this slide to really be a bit of a snapshot so you can see immediately whether it's something you need to consider. If we do have any not-for-profits listening, you are only impacted if you are currently doing RDR accounts. So for any of those listening, it's only the RDR. The for-profits, the majority of you who are listening, if you are currently preparing full general purpose tier 1 accounts, so full IFRS accounts, and that might be because you're in the listed space or a financial institution, you don't have any impact. You continue doing what you're doing, probably will never have any impact except when IFRS puts out some new changes. If you are doing reduced disclosure financial statements, you will be impacted. However, your numbers will not change because your RDR, your tier 2 accounts are already general purpose. You're already complying with recognition and measurement. So what you will see is some disclosure changes. RDR will no longer exist, so you will not be able to do that. You will move on to the new tier 2 that we'll talk about. If you're currently doing special purpose financial statements, the level of impact for you depends. It depends on what you're currently doing in your special purpose financial statements. There is a huge range of what we see in special purpose financial statements, varying from a MYOB print of a balance sheet and a P&L to a really good set of special purpose accounts that almost look like they could be general purpose. So the first thing that we need to understand is, are you complying with all recognition and measurement requirements? And that includes consolidation and equity accounting. So you may be currently doing all the numbers, but you just haven't consolidated your subsidiaries because you believe that consolidation was a presentation standard. So if you're not currently complying with all recognition, measurement, consolidation, and equity accounting, and you're going to be sick of me saying that phrase throughout this session, then you are going to have a change in your numbers. You're going to have the biggest impact. If you are currently complying with recognition, measurement, consolidation, and equity accounting, you're just going to have some disclosure changes. So it really depends on what you're currently doing to see what the impact is. So hopefully we can explore that a little bit more and answer any questions you might have. So let's look first of all at what, got excited and jumped ahead a slide, at what our general purpose financial statements will look like. As I've mentioned, our tier 1, our full IFRS accounts will still exist. We have no change in those. What we're anticipating is anyone who is having to move to general purpose will move to tier 2. If you believe you want to jump to tier 1, ask yourself why. Just because it's called tier 1 and tier 2 doesn't mean tier 1 is better. Tier 1 has more information, but more information is not always better. So just be aware of that. Tier 2 will probably give much better information to your users. So tier 2 is now called the Simplified Disclosure Standard, which is AASB 1060. The way that we put together our tier 2 general purpose financial statements is we take all of the recognition and measurement requirement from all of the AASBs. So if we wanted to know, for example, how we recognize and measure property, plant and equipment, we go to the Property, Plant and Equipment Standard, AASB 116. We do consolidation and equity accounting from the relevant standards, AASB 10, AASB 128. But within those standards, as soon as we hit the standard bit that talks about presentation or disclosure, we put that standard down and we pick up AASB 1060. That's got all of the presentation requirements and all of the disclosure requirements that you will need to do if you are doing tier 2 financials. So no longer are you hunting through and looking for shaded bits and parts of sentences that are shaded. It's very much a separate standalone standard that will deal with all the presentation and disclosure requirements. The standard's split into sections. So we talked about you doing recognition and measurement for property, plant and equipment. If you want to know your disclosures for property, plant and equipment, you look in the section of 1060 called property, plant and equipment, and that lists the disclosures. It's a very easy standard to read. It is based on IFRS for SME. None of you have probably read IFRS for SME, but it is the most plain English standard that we have in our suite of standards. So it's much easier to read. They don't necessarily correlate with the main requirements in, for example, the property, plant, equipment standard. They're written very much to be a standalone basis. So that's the two tiers that we got. So when we talk about RDR will no longer exist, we will still have a tier 2. It's just a different tier 2 from the one that we've got. So if we are currently doing RDR, regardless of the sector that you're in, whether you're a for-profit or a not-for-profit, RDR will no longer exist from the 1st of July 2021. So that's 30 June 2022 onwards. At 30 June 21, you can choose to continue to do RDR, or you can choose to move to simplified disclosure early. Entirely your choice. The only advantage for you for moving early is there are a couple of extra disclosures that go in under simplified disclosure. For example, audit fees and imputation credits. If you choose to early adopt, you don't need to disclose comparatives for those two or for any other extra disclosures. It's a bit of an incentive. It's not really a huge incentive, so entirely up to you. So your financials going forward will refer to Australian Accounting Standards - simplified disclosures rather than Australian Accounting Standards - reduced disclosure requirements. And the way that you convert from one set to the other, you've got two choices. I have a very strong preference for which choice we should be taking, which you'll probably be able to tell in the wording that I'm going to say. The first thing you can do is you take your RDR accounts, you knock out all of the disclosures that are no longer required by 1060, you add in the extra few disclosures that are required by 1060, and there you go, you've got your simplified disclosure financials. Simplified disclosure is always a minimum level, but those financials will disclose all the information that's required. It will take longer on day one, but going forward, you will have less notes to prepare, less notes to have audited. The other way of doing it is to say, we just want it as quick as possible on transition. So what you do is you take your existing RDR and you add in the extra disclosures that are required by SDS. That's my least preferred. It's much quicker on day one because I'm just adding in extra information, but I'm still ending up with extra disclosures that aren't required anymore. So why waste time going forward preparing those extra disclosures, getting those extra disclosures audited when they're not needed? So think carefully about how you are going to move from your RDR to your SDS. As I say, just look through. There will be overall much less disclosures than under RDR. So hopefully the financial statements will be a little bit easier to prepare going forward. So that's moving from RDR to SDS. What I want to focus on now is if you are currently preparing special purpose financial statements, and how do you know if no longer you're going to be able to do that? So you're going to have to move from special purpose to general purpose. These two criteria we've talked about in previous sessions, and we just want to reiterate it and talk through them again. So there's no longer going to be a judgment call around whether you can do general purpose. No longer can you tell me that you don't have any users of your financial statements and the only people that use them can request the information. That reporting entity concept will no longer exist. It's very much black and white now. So from the 30th of June 22, which is the mandatory date, the absolute drop dead date, if you meet one of these two criteria on the slide, you are no longer able to prepare special purpose accounts. So the first criteria is that you are required by legislation to prepare financial statements that comply with Australian accounting standards or accounting standards. So that's any legislation that requires that. We're going to use the Corporations Act as an example because it's the most common one, it's the one that everybody knows. So if I was in a room with you, I'd be asking you to tell me which entities required to prepare financial statements in the Corporations Act. You're not in a room with me, and I'm not going to wait for things to be typed in, so I'm going to answer it myself. Large proprietaries, small foreign-owned proprietaries, Australian financial service license holders, small proprietaries who do crowdsourced funding, small proprietaries who are under an ASIC direction or a member direction to prepare financial statements in accordance with the Corps Act. Reasonable number of entities that would be captured. So if we use the Corporations Act as an example, all of those entities that I've talked about from 30th of June 2022 will be required to prepare general purpose financial statements. So it's not a choice, it's not an option. We're not having a 20-minute discussion about why you should be out of it. It's an absolute given that if you are required by the legislation, you are doing general purpose financials, either tier 1 or more probably tier 2. The next criteria, and you'll notice it is an or criteria, it is not an and criteria. You are required by your constituting or other document, and that could be a trust deed, it could be a partnership agreement, it could be a joint venture agreement, a bank agreement, a constitution, for example. And that document requires you to prepare financial statements that comply with Australian accounting standards. I'm going to cover the second bit of that box in a second, but you'll notice that the red box says Australian accounting standards or accounting standards. The black box says Australian accounting standards only. It's not a typo, it's not because I couldn't fit any more into the box, it's deliberate. The legislation can require either. Your other document has to specifically require Australian accounting standards as a reference, those 3 words that need to be in there. So let's cover off the timing. If this constituting or other document requires preparation of financial statements in accordance with Australian accounting standards, the next thing that you have to do is work out when that document was created or amended. So if that document was created before the 1st of July 2021 and has not been changed in any way since that date, the standard allows grandfathering, so it allows you to continue to prepare special purpose financial statements if you want to. You can always move to general purpose, but if you want to, you can continue to do special purpose. There will be some additional disclosures, and they'll be around things like transparency of whether you're complying with recognition and measurement. Are you consolidating or equity accounting? That is going to be in a standard that is due to be released anytime. I have been saying imminently for the last 5 months. We're expecting it at any time. So you will see that standard that provides the extra disclosure. If, however, the document was created after the 1st of July 2021, or since that date has been changed for any reason, and that sentence in black, in the black box at the top, has remained within that document, you are required to prepare general purpose financial statements. Again, no choice, no discussion, no telling me the reason why you think that's not appropriate for you. This is what the standards will require you to do. So they're the 2 criteria, and that's what we've got to keep coming back to. So every time we're looking and saying, do we have to do special purpose or general purpose? If we meet one of these criteria on the slide, you are preparing general purpose financial statements. So that's the who. When do we adopt this? I've said that the mandatory date is 30 June 2022. So you have a choice. You can either early adopt or you can not. If you adopt it on the mandatory date, and I picked 4 year ends here, I realize some of you listening may have a different year end, but hopefully you can figure out where your year end sits in between these 4 examples. So mandatory adoption, and I'm just going to use June year ends. Mandatory adoption is 30 June 2022. That is the latest time that you can move from your special purpose to general purpose. Latest time you can move from your RDR to your simplified disclosure. Early adoption, therefore, is any time before then. Now, given that we've only got 1 June year end before then, that's 30 June 21. So we're at the 20th of May. It doesn't give us a huge amount of time, but you may decide to early adopt. And the standard does include some incentives for early adoption. So in order to move from our special purpose to our general purpose, assuming we aren't complying with recognition, measurement, consolidation, and equity accounting, so assuming we have some numerical change, we have to create an opening balance sheet. Our opening balance sheet will be for June year ends 1st of July 2020, regardless of whether I early adopt or whether I don't. And that's because if I adopt it on the mandatory date, so if I do 30 June 22, my opening balance sheet date is the beginning of the comparative period, 1st of July 2020. If I early adopt, my opening balance sheet date is the beginning of the current period, 1st of July 2020. So far, no incentive. I've got the same date. Why would I do that? And what does it mean at the opening balance sheet date? It means that when we get our numbers that weren't complying to numbers that do comply, we put all adjustments through opening retained earnings at that date. So 1st of July 20 is when all the adjustments go through to retained earnings. How do we create that opening balance sheet? We know that all adjustments go to retained earnings. We have a choice. Again, as I talk, it's going to be very clear which is my preferred option and what you should do. So the first choice that you have is to go through AASB 108. So this is the standard that's been around since we transitioned to IFRS. And that requires us to apply all standards as if they've always been used. So when I undertook a particular balance or transaction, when it entered onto my books, I look at the standard that was in play at that date. And then I pretend that I'd happily had that balance and I'd kept accounting for it. And any change to the accounting standard, I had to process and I had to deal with it then. It's incredibly complicated and involves a huge amount of work because you're having to track everything that's happened from the date that balance or transaction appeared in your financial statements. There is also significant disclosures around this one. So I'll refer to it as a little bit later on a third balance sheet, but it's disclosures on a line by line basis. Effectively, every single line that is impacted, you will have to put that disclosure in there. My preferred option is that we go through AASB 1. Now, those of you who've been around and remember the transition to IFRS back in 2005 might remember the funny little standard, AASB 1, that we've all ignored for the last 15 years. What this standard allows you to do is to say you can use the standards that are in place at the end of the current year. So let's assume I early adopted it. The end of the current year would be 30 June 21, and I apply those standards at 1st of July 20. And I put all adjustments through my opening balance sheet without having to worry about what happened in the past. In addition, the other advantage of this standard is it gives you much more flexibility. There are certain things that you don't need to retrospectively restate. Some of them are mandatory. For example, with financial instruments, you don't need to worry about whether I've got a classification change in the way I've classified my financial instruments. You use the benefit of hindsight and you say at the 1st of July 20, how would I classify them now? There's also voluntary exceptions. So for things like your business combinations, you can choose not to restate them. If you're currently carrying everything at fair value, you can choose where there's an option in the standard for the cost model to deem the fair value to be the cost. So there's some real advantages in this standard, gives you more flexibility, and in my view is much easier. If one option is much easier than the other, always go the easy option. So when we start talking about AASB 1, when you're actually looking at this transition, it's very, very definitely an option that you should be seriously considering. So why am I keeping talking about an early adoption date? I said that there was incentives for early adoption. So let's look at what they are. If we choose to early adopt this standard, so if we move from special purpose to general purpose and we do it at the 30 June 21, there is a relief that is a relief from restating comparatives. So your 30 June 21 numbers will be in full compliance with recognition, measurement, consolidation, and equity accounting, including all the relevant disclosures from Tier 2. So that column, if you imagine that this is a column in your financial statements, that column would be full compliance. I've talked about the opening balance sheet being at 1st of July 20, and the green one isn't a column. It's just a date to actually give you some context for a time frame. As at that 1st of July 20, that's when you make sure that you bring all of your numbers to where they should be and all adjustments go through. The level of disclosures vary depending on which option you choose, whether you use AASB 1, in which case all you have to do is a retained earnings reconciliation, or whether you use 108. As I say, I've called it a third balance sheet here, but effectively it's a line-by-line adjustment. My personal view is if you are showing some lines of your balance sheet, but not all of them, it doesn't make any sense. So I would recreate that third balance sheet, and you can do it in the notes. It doesn't need to be on the face of the statement. So another reason not to do 108, because it's extra disclosure. So that's my current year numbers. So I've got the current year column being full compliance with recognition, measurement, consolidation, and equity accounting. I've got a retained earnings reconciliation sat in the notes. My comparative column is whatever I did last year. Let's say I'm having to move and I have to consolidate in 2021. My 2021 column is a consolidated column. My 30 June 20 column is a single entity column that may or may not have complied with recognition last year. So I obviously star it and I say this was prepared in accordance with the special purpose framework, but I don't need to do anything with it. Those numbers were already previously audited, those numbers were prepared, those numbers were lodged if that's what was needed to happen. You don't have comparability, and the board fully acknowledges that you lose that comparability, but their preference was to get your numbers right earlier, so at 30 June 21. So it's only available, this comparative relief restatement, if you early adopt the standard and if you did not previously comply with all recognition, measurement, consolidation, and equity accounting. Because if you did previously comply, there's no change in your numbers, so it doesn't matter about restating. So that's my carrot for early adoption. What if we don't early adopt? What if we adopt it on the mandatory date? So we're assuming now that the entity has adopted at 30 June 22. In that case, the entity is required to fully restate comparative information. So when I look at the 30 June 22 accounts, I have current year in accordance with recognition, measurement, consolidation, and equity accounting, and all the associated disclosures. Prior year, full compliance with recognition, measurement, consolidation, consolidation and equity accounting. All the numbers, the adjustments at the opening balance sheet go through on that 1st of July 20, so exactly the same date that we've already talked about. So why is the early adoption such a carrot? Because if I choose to do this at the mandatory date, I've already done the 30 June 21 numbers under whatever basis I was using. I prepared them, they were audited, and they were lodged. At 30 June 22, I have to re-prepare them. I have to get them re-audited. It's taking a significant amount of time. So that yellow column is effectively being done twice. And that's the big carrot for that not restating. It will save you costs, and I believe will save you time. I'm aware that we haven't got a huge amount of time before 30 June 21, but I would seriously consider those of you listening who aren't currently complying with recognition, measurement, consolidation, and equity accounting to make sure that at least you're considering your options and understand the impact of them and potentially the additional time and costs if you do not adopt this year. So that's all I had to say. So I'm going to hand over to Michelle, and then we're going to have a question and answer session at the end. So please feel free to type those in.
Thank you, Carmen. It's amazing. I think I've heard you present on special purpose removal a couple of times, and every time I learn something new. So amazing. We're going to move away from special purpose to ASIC for a minute. As we head into the June reporting season, it's always a good idea to know what's on ASIC's radar, because these are the things ASIC will focus on when they do their financial statement surveillance reviews and when they do their audit file inspections. And if directors and auditors get these things wrong, it could lead to naming and shaming of the company or the audit firm concerned. So ASIC has not yet announced its focus areas for 30 June 2021, but I suspect they will be similar to what was announced for June and December last year. So asset values, provisions, solvency and going concern assessments, which could still be a challenge for some entities in the current environment. also subsequent events, the adequacy of disclosures, and the operating and financial review, or the OFR. ASIC is definitely paying attention to what directors are or aren't saying in the OFR. So I do encourage directors to take the time and make sure that the OFR complements the rest of the financial report. If there is one theme I could pick on, it would be impairment. Certainly internally, this is what we are focusing on at the moment. Impairment continues to be top of ASIC's findings list, which shows that directors and auditors continue to struggle with this area. So some of the things that ASIC has commented on in the 30 June 2020 reviews, cash flow forecasts and the assumptions that underlie the impairment model, they're not reasonable and supportable. That is, they don't stack up against actual historical cash flows. They don't make sense when compared to economic and market conditions, or sometimes they haven't been updated to reflect the impact of COVID-19. ASIC has also been finding that entities sometimes identify cash generating units, or CGUs, at too high a level, which runs the risk that impairment losses that should be recognized aren't. And that's because they are hidden by other good or well-performing assets in the same CGU. Something else ASIC is definitely checking is that impairment models have been updated to reflect the change in the way that lessees account for leases under the new leases standard. So are carrying amounts of CGUs being tested for impairment? Do they include the right of use assets that have been recognized on balance sheet? And at the same time, have the cash flows in the impairment models been adjusted to essentially exclude those lease payments that are taken into account in calculating the lease liability that's been recognized on the balance sheet? So something to just take note of. ASIC also feels that the disclosures around impairments can be improved. And this is to make sure that users of financial statements understand the assumptions and the inputs that management have used to justify the carrying value of an asset, so that they can make their own assessment about the potential for impairment. And then very often ASIC reviews lead to ASIC restatements. And I've just listed there the two that have been announced since January this year. Coincidentally, all of the restatements listed there relate in some shape or form to impairment of assets. So goodwill, deferred tax assets, non-financial assets, expected credit losses, which ties into the recoverability of debtors, and inventories, this is just a further reminder that impairment should remain a key focus area for directors. There we go. All right, for the June reporters that have tuned in today, I'm sure you're aware, but just to remind you that ASIC has granted you an additional month to lodge your financial statements. The extension applies to both listed and unlisted entities reporting under Chapter 2M of the Corporations Act, and where the balance date is between 23 June 2021 up until 7 July 2021. And I've just gone and summarized the extended deadlines per type of entity that reports under Chapter 2M of the Corps Act. Listed entities, just take note that there has been no change to the reporting deadlines for your preliminary final reports. Those deadlines remain unchanged, but those reports can be unaudited. And for the listed entities that do rely on ASIC's lodgement extension, you need to inform the market, and you are encouraged to disclose the reasons for relying on the extension. In terms of annual general meetings, the status quo remains. So public companies with year ends of up to 7 July 2021, you still have an additional 2 months to hold your AGMs without ASIC taking any action. All right. For the AFS licensees that report under Chapter 7 of the Corps Act, where you have a 30 June 2021 balance date, you also have an extra month to lodge your profit and loss statements and balance sheets with ASIC. And again, I've just summarized per type of AFS licensee, the extended deadlines on the slide. Staying with AFS licensees, ASIC has recently announced that AFS licensees that have right of use assets arising under the new leases standard can use those right of use assets in satisfying their financial requirements. So before the media announcements, these right of use assets they were considered intangible assets, and they couldn't be taken into account in calculating certain financial requirements. But at the same time, the related lease liability had to be included, which means that some AFS licensees were breaching their license conditions because of a new accounting standard. Anyway, ASIC has now made a few amendments to provide that these right-of-use assets are no longer considered excluded assets. So these right-of-use assets can now be included when calculating adjusted assets and in turn net tangible assets, surplus liquid funds, and adjusted surplus liquid funds. All right, let's move away from ASIC, and we're going to now look at the new accounting standards that will be applicable for 30 June 2021. You'll be happy to know that there's nothing too exciting going on this front. All of the pronouncements there on the slide, apart from the last one, they are effective for annual reporting periods beginning on or after 1 January 2020. So our December reporters, you would already be applying these if they are relevant for you. Our June reporters, you would be applying these for the first time in your 30 June 2021 financial statements if they are applicable. So there's really 3 amendments that I'd like to focus on, being the ones that are probably more relevant for our audience today. So starting with the refined definition of a business, this amendment will be relevant for you if you've had any acquisitions since 1 January 2020. Making the distinction between an asset acquisition and the acquisition of a business is very important because the accounting for each is very different. For example, the acquisition of a business may give rise to goodwill, but an asset acquisition never gives rise to goodwill. These amendments to AASB 3 are aimed at making this distinction easier for entities. What has changed? At a very high level, the amendments to the definition of a business has been tweaked to narrow the meaning of outputs to focus on goods or services to customers, investment income, and other income from ordinary activities. And also the reference to the ability to reduce costs has been removed from the definition, because really an asset acquisition can also have the lead to reduced costs. So that reference wasn't particularly helpful. The standard also now makes it clear that to be considered a business, there must be at a minimum an input and a substantive process that together significantly contribute to the ability to generate outputs. And more guidance and examples have been added to the standard to really help entities assess whether or not a process that has been acquired is in fact substantive. The amendments also introduce a new optional fair value concentration test, which is a shortcut way of concluding that an acquisition is not a business combination. So the test is passed if substantially all the fair value of the gross assets acquired is concentrated in a single asset or a group of similar assets. So if the test is passed, no further analysis under AASB 3 is required, despite the presence of any other factors or considerations. If the test is failed or it's not passed, or the test is not applied because it's optional, well, then a detailed assessment that works through the requirements of AASB 3, the business combination standard, will need to be done. And there's very specific rules that need to be followed when performing this optional concentration test, but there's a really good example in the standard that shows how those rules should be applied. So please do refer to it if you need to. All right. Another amendment worth just mentioning is that from 1 January 2020, the definition of material has also been refined because of difficulty in applying the old definition in practice. Preparers of financial statements apply the concept of materiality in many decisions when preparing the financial statements. So, for example, in applying accounting policies, in determining what disclosures are most meaningful to users, and in deciding in the appropriate level of aggregation of financial information in the financial statements. So the aim of revising the definition of material is to really simplify financial statements and increase their usability. What has changed? Again, very briefly, could influence has been changed to could reasonably be expected to influence. And this adds the element of reasonability to the definition, which really narrows the potential pool of disclosures that could be made. Also, the word obscuring has been added to the definition, and that really emphasizes that obscuring information can have the same effect on decisions made by users of financial statements as omitting or misstating information. So if the new and improved definition of material is applied properly by preparers when preparing their financial statements, the end result could be more meaningful, more relevant financial statements. I'm sure everyone would agree that less is more when it comes to the number of pages in a set of accounts. So let's only disclose the material stuff. Let's prioritize the important stuff by moving it to the beginning of the notes, not the end. Let's clean up, let's streamline by aggregating immaterial classes of balances and transactions while separately presenting those items that are significant. So hopefully the added guidance and the improved explanations that now will appear in AASB 101 will make it easier for preparers to apply the concept of materiality in making judgment calls when it comes to preparing their accounts, instead of just ticking boxes on disclosure checklists. All right. For those entities that have received rent concessions from their landlords because of COVID-19, this amendment is for you. You may recall that last year, AASB 16, the new leases standard, was amended to provide practical relief to lessees who are given COVID-19 related rent concessions. So without this relief, lessees would have to go and assess whether these rent concessions are lease modifications. And where they are, they have to go and apply lease modification accounting, which involves remeasuring the lease liability using an updated discount rate, and then adjusting the right of use asset and or profit or loss, depending on the type of concession granted. Using the relief that's been added to AASB 16, the lessees would not have to assess whether these COVID-19 related rent concessions are lease modifications. They can just treat them as essentially negative variable lease payments through profit and loss. To be eligible for the simplified accounting, the rent concessions must meet all three of those criteria on the slide. This particular amendment under AASB 2021-3 just extends the scope of the original relief by 12 months. So those rent concessions that those rent concessions that reduce lease payments originally due on or before 30 June 2022, not 2021, will be eligible to be treated as variable lease payments as long as the other two criteria are met. Unfortunately, no, can't change the slide. Sorry. There we go. Unfortunately, this example never made it into the amendment to AASB 16, which is a real pity, even though it appeared in the IASB staff paper. It's a really simple example, but very nicely shows how the rent concessions should be treated using the practical expedient I've just talked about. So please do refer to this if you want to see what the accounting looks like for forgiveness of lease payments, deferral of lease payments, or perhaps a combination of both. Right, and then I thought I'd just throw in there, let's not forget about the old new standards, as I now call them. Good old AASB 9, AASB 15, and AASB 16. Hopefully we are all a bit more comfortable with these standards as they've been around a while now, but they are still difficult standards to apply. And unfortunately, in most cases, these are not set and forget type standards. So if you enter, every time you enter into a new lease agreement or you modify an existing one, you're going to have to consider AASB 16. Every time you enter into a new sales agreement, revenue contract, you're going to have to work through the 5-step revenue recognition model in AASB 15. And on that note, revenue recognition actually came in with the second highest number of queries by ASIC, after impairment, of course, in the 30 June 2020 reviews. So I think these standards will continue to be on ASIC's radar a while longer. So best we just keep on improving on them. And then just to bring to your attention accounting changes that will only become mandatory in 2023, but they could be worthwhile adopting early because it really wouldn't be difficult to do so. AASB 2021-2 introduces amendments that are aimed at improving accounting policy disclosures. Now, I don't know about you, but accounting policies don't very often get a lot of attention. I can see Carmen smiling, unless you're a Carmen or unless you're a Michelle that sits and reviews financial statements. These amendments, under these amendments, entities will now have to disclose their material accounting policies, not their significant accounting policies. And this should be easier for entities to do because the concept of materiality, as we've just discussed a few slides back, is already dealt with in the accounting standards. The same amending standard also introduces a definition for accounting estimates. Previously, there was only a definition for changes in accounting estimates. So accounting estimates has now been defined. And the amendment also clarifies how to distinguish between a change in accounting policy and a change in accounting estimate, which is important because a change in accounting policy is generally applied retrospectively, whereas a change in accounting estimate is applied on a prospective basis. So just something to be aware of. If you perhaps do want to consider adopting early, please refer to AASB 2021-2. In terms of global developments, there are two that I thought I'd bring to your attention, starting with this one. Now, there have been amendments to the accounting requirements that deal with the classification of liabilities as either current or non-current. While these amendments don't change the existing requirements, they were added to reduce the current diversity in practice in applying them. Now, the IFRS Interpretations Committee was recently asked about how to apply one of the recent amendments to a scenario in which a long-term loan has covenants attached to it, and those covenants are tested for compliance at dates after reporting dates. And the Interpretations Committee came back saying, well, their view is that applying this amendment means that the borrower in this case would have to perform a hypothetical test of compliance of the future condition using numbers at reporting date. And if the future condition is not met at reporting date, that debt would have to be classified as current. And this just doesn't make sense because very often covenants are tailored to suit the needs of entities, whether that's for seasonality purposes or because of the stage of operations that the company is in. Using a hypothetical test to classify debt wouldn't reflect the purpose or the economic substance of the covenants, nor would it reflect the contractual rights and obligations at reporting date of the parties involved. So needless to say, there's been quite strong pushback from stakeholders around the globe on this matter, and it's now been referred back to the International Board. Luckily, these amendments only kick in from 1 January 2023. I see I haven't put it on the slide there. You might just want to take a note. These amendments only kick in 1 January 2023. So there is a bit of time to sort out the mess. But if you do have covenants that are tested for compliance at various points throughout the year, best you watch this space, because potentially you may have to change the classification of your liabilities should these amendments remain as they are. So just wanted to highlight that. And then lastly, I'd just like to point out some educational material on going concern that was published by the IFRS Foundation earlier this year. There've been no changes to the accounting requirements or the accounting standards as they relate to going concern, but obviously it has been a topical area since the pandemic hit. The educational guidance just highlights or emphasizes that not only do you have to disclose material uncertainties relating to an entity's ability to continue as a going concern, but you also have to disclose any significant judgments involved in reaching the conclusion that there are or there aren't material uncertainties. The guidance also reminds entities that all events that happen from reporting date up until the date that the financial statements are authorized for issue have to be taken into account in making an assessment about going concern. So this diagram on the slide comes from the publication, and it just summarizes how the requirements of AASB 101 should be applied to 4 different scenarios. On the one end of the spectrum, you've got a company that's profitable, no liquidity concerns. Well, then there would be no specific going concern disclosures that would need to be made. On the other end of the spectrum, you've got a company that needs to shut its doors. So preparing the financial statements on a going concern basis would no longer be appropriate. And then in between, you've got varying circumstances where entities are going to have to exercise judgment, and they're going to have to disclose the appropriate level of disclosures about going concern in order to comply with AASB 101 and AASB 110. So that's just an FYI. If you know, please do refer to this little publication. It's not difficult to read. It's quite nicely written, especially if you need some guidance on those close going concern calls. And that's it from me.
All right, thank you very much, Michelle, and thank you very much, Carmen, as well. Very insightful presentation. And again, it's when you think that nothing's really changing, things are still changing, and they'll continue to change in the future. Now, just a couple of questions just to just confirm some of the things. So, Carmen, we were talking about the special purpose, and we're talking here about a for-profit who is not required by legislation to prepare accounts. So it's prepared because of either a constitution governing document or the banks requiring it. So just to confirm, if prior, they go back, the old constitution does make reference to Australian accounting standards, but they've prepared special purpose in the past, they're allowed to continue to prepare special purpose going forward, assuming there's no change to that document.
Yep, correct. Assuming there's no change to that document, and that's any change at all. That's not just a financial reporting change, any change at all, but there will be additional disclosures that are required in those special purpose accounts.
Yep, and if they do make a change, as long as they don't use the words Australian accounting standards, then they can still, if they said Australian, what wording would they use actually? As long as they don't use Australian accounting standards.
How about I tell you some wording?
Yes, yes,
right.
that sounds good.
So I would use wording something along the lines of prepare financial statements in accordance with the requirements of the trustee, the partner, the joint venture partners, whoever it is. So really give that flexibility that if the trustee, the joint venture partners, the partners, whoever it is, says we want general purpose, well, they can ask for it. If they say we want cash accounting, they can ask for that. So I would remove all judgment, and I would use those type of words. If you're already doing a change to the trustee, to the agreement, whatever that document is, then I would be changing that sentence. Yep,
that was the suggestion I was going to use for that wording as well. I
just jumped in too quick.
It's all right, you can interrupt. And then Michelle, the business combination and the looking at whether it's an asset acquisition or it is a business combination. When you're looking at the definition of a business, does that apply to both entities, the acquiring and the acquiree, or is it just the company, the entity being acquired?
I would have thought it's the entity being acquired needs to be a business.
Okay.
To apply the acquisition method of accounting. Am I right, Carmen?
Yeah, I would agree with that, because it's all about the things that are being transferred.
Yeah.
And that has to be a business or not.
Yep.
Okay, so could you have, well, we'll get to this. I guess my example is going to reverse acquisitions, etc. So we'll go into that. If you had a holding company that's pretty much dormant and it's acquiring a subsidiary which is trading, that would more likely be a reverse acquisition.
Yes.
I suggest.
Yes.
Okay, and then with the material, going forward a couple of years, they'll be there in no time. The material disclosure of the material accounting standards. So does that then mean that if you've got balances in there that are not material, like your plant and equipment, you can remove your accounting policy on plant and equipment?
Look, at the end of the day, the balance on the balance sheet is also, it's a net amount. So I guess it would also depend on cost, accumulated depreciation. If all of those line items are immaterial in the grand scheme of things, well, why would you open the note? Why would you put in accounting policy?
If I can add to that as well, I would argue that if you've got an immaterial balance now, why have you got an accounting policy in? Because it's not a significant accounting policy for you. So when the international standard talks about material accounting policies, it talks about things like where there's a choice within the standard. So are you holding your PP&E cost or at fair value, to explain those decisions? If something is copied from an accounting standard, there's no judgment, it's not a complex issue. They're the type of things it wants you to get out. So you might actually end up with some material balances, but there was no judgment involved, there was no choices involved in the accounting policy, and they can come out as well.
Instead of just rehashing the wording out of this accounting standard.
Yeah, that's a good point, because all of the accounting policies are just, there's no choice, and it just says what the standard says.
Yes.
And you go, well, you're reading that, well, you don't really have a choice there, that's what the standard says. Tax is one. Now, tax, you might have tax consolidation, other things that are there is a choice to consolidate or not, but often taxes you've got to do recognised. There could be judgment, but yeah, if it's just a straightforward tax note. Interesting. It's stuff to think about going forward. All right, thank you, Carmen and Michelle. Don't have any other questions that have come through, but before we do conclude the webinar, I want to draw your attention to the bottom line, issue 9. So this is a publication that Michelle here writes. It's to keep us all in the loop about the latest accounting, financial reporting developments, potential impact they might have on you. So Michelle, would you like to comment on what this latest issue is about?
Well, I see that, yeah, sure, no problem. I see that some of these topics in this issue we actually covered today. In particular, the feature article in issue 9 is all about the amendments to AASB 3, the business combination standard. So we flesh it out in quite a bit of detail, work through those. And there's a worked example of how to calculate the fair value of the gross assets acquired when performing the fair value concentration test. So that might be useful. And then we also cover in a little bit more detail than what I've talked today, the COVID-19 related rent concessions, the practical relief around that, and the 12-month extension. And yeah, we also go into a bit of detail about these amendments that improve the accounting policy disclosures and the introduction of the accounting estimates definition. So please do have a read. Oh, and if you are interested in a bit of information on what Carmen spoke about today, so the removal of special purpose, we have covered that to some extent in previous editions of the bottom line. So just go and have a search.
Yes, that's editions 1 to 8. So you don't need to search hundreds of editions. You can read them all. They're very easy to read as well. It makes things very practical terms. So I recommend you all do it. You're all going to be receiving a link. So if you don't already receive an email telling you the bottom line, everyone attending this seminar will be receiving a link so you can access it. Okay. So I'd like to thank our panelists once again this morning. If you'd like a call back or like further information on any of the topics, you'll see a poll that's come up just now. So if you want us to contact you regarding tax financial reporting matters or even any other matters, please respond now, and then we'll review those responses and we will get back to you if requested. So thank you again to Carmen and Michelle. We hope you've all enjoyed this presentation, and yeah, we'll see you all next time at the next presentation or when we come out to see you. Just to also let you know, the recording of this and the PowerPoint slides will also be sent to you along with a link to the bottom line. Okay, thanks again, and we'll see you all next time.